Begin in a couple. Good morning, good afternoon, good evening, everyone. Thank you so much for joining us today. And welcome to our session on demystifying the One Big Beautiful Bill. While the name is charming for companies in the US India corridor, spanning technology, consumer goods, aerospace, pharmaceuticals, financial services, logistics, and manufacturing, this is serious business. The One Big Beautiful Bill could reshape US tax rates, impacting your margins, tighten compliance on cross border transactions, alter transfer pricing rules, adjust benefits, and revise tax credits and deductions. In short, it affects everything from audit exposure to your global workforce strategy. Understanding it now is not just useful, it's essential for planning, compliance, and staying competitive. Today, we'll be discussing the background, timeline, and current status of the One Big Beautiful Bill, corporation related provisions such as cost recovery, business interest modifications, and suspension of domestic R&E capitalization, international provisions including changes to GILTI, FDII, and BEAT, individual related provisions like the qualified business income deduction and other beneficial measures, and finally, key insights from Ryan on how businesses can prepare and adapt. We are very pleased to be joined by Mr. Sam Tay, Principal at Ryan, a leading global tax services and software provider working with multinationals in over 60 countries to minimize tax burdens and recover overpaid taxes. Thank you so much for joining us, Sam. Sam brings extensive experience leading international income tax teams and advising on complex cross border transactions. His insights will be invaluable in unpacking what OBBB really means. Our special thanks to SW India for partnering with us, especially Kunal Mehra, Managing Partner and co founder SW, as well as Nitin Jain, Partner in International Tax SW. Kunal, a CPA with over 23 years in audit and advisory, has guided Fortune 500 companies and startups across industries like IT, manufacturing, and power through complex global engagements. Nitin, a chartered accountant with 25 years of experience, offers deep expertise in international tax, M&A, transaction structuring, and transfer pricing across sectors including telecom and pharma. Together, they play key roles in helping companies navigate evolving tax landscapes. We are very thankful for both Kunal and Nitin for joining us today. With such a powerful panel, I am confident we'll leave today with OBBB not just as the one big beautiful bill, but as the one big beautifully understood bill. So let's get started. Over to you, Sam.
Thank you very much, Shreya. So today we'll be discussing how to demystify or decode the One Big Beautiful Bill. You'll notice that it's commonly referenced by tax practitioners as OB3, but the intent of today is to really simplify and help you understand what these changes mean to you and your organization. With that, we will get started on the presentation. My name is Samuel Tay. I'm a principal in the International Income Tax Group here at Ryan, and I will be the host for today's session. Today, we're going to start by going through really the timeline and the current status of the tax reform bill. Then we'll go into the domestic provisions that will impact your corporation here in the US. And then we're going to talk a little bit about the individual provisions that may impact you individually as you continue to grow and invest in your business. And then at the end, we'll talk a little bit about things that you can do today to help prepare you for the changes that are coming at the end of the year. So with that, here's really the summary of the One Big Beautiful Bill. If you'll see, it really only got started in May and it was passed in July. I mean, this is the fastest we've ever seen a tax bill go through Congress and get signed into law. To give you a little bit of perspective, the last time we had tax reform was 2017 when we had the same administration. But before that, we didn't have any material changes in our tax code since 1986. So you can imagine how quickly this had to happen and Congress really agree on some of the impactful provisions in such a short period of time. So that's what brings us here today to talk about what changes have been made from the passage of OB3. Big picture, it's broken into really three sections. The today column is what our rates and impacts are today. The middle column is what would have happened in 2026 at the end of this year had we not had the passage of OB3. And then the third column to the right is what OB3 did to impact the rates for all of us here today. So the corporate tax rate all remains the same at 21% under all three scenarios, as well as our corporate alternative minimum tax, which is at 15%. The corporate AMT, which is referenced as CAMT, only impacts large organizations over $1 billion in financial revenue. But when we go down to some of the international provisions, you'll see that the rate in 2026 was going to increase had we not had the passage of this recent tax bill. And the reason for that is when the TCJA was passed in 2017, they were all set to be temporary and sunset at the end of 2025. And the only way, or the reason that that was done is the only way to get that bill approved through our budgeting process was to make sure that we give tax savings on the front end, but we would make it up on the back end. Fortunately, with the passage of OB3, we're able to make these things permanent. And so now we'll go into each one of these, what it really means and how it's going to impact you and your organization. So the first thing is bonus depreciation. If you're in the manufacturing industry or you have a capital intensive business, you'll know that this is a huge benefit for your organization. Before the passage of OB3, we were only at 40% of bonus depreciation in the current year, which means you could immediately deduct 40% of the cost of any asset that had a 5, 7, or 15-year taxable life. Next year, it would have went to 20%, and then you would have had to have just depreciated it over its standard life. Now, any asset that you put into your organization after January 19th, you can immediately deduct and write off that expense. And so this will be a huge benefit for organizations, again, that have been investing in their business to help grow and thrive. Another benefit is this new factory improvement incentive where you can deduct 100% of any qualified production property that you put into your factory. So typically, the bonus depreciation that we talked about before only applied to fixed assets and machinery that had 5, 7, or 15-year life. This is for other improvements that you may be making to your facility, right? That may be, track lighting, different structural changes that you're making to your actual manufacturing facility that would have had to have been depreciated over 39 years can now be immediately deducted as long as it's a qualified improvement that impacts your manufacturing, production, or tangible product. So here's a good simplified example. Let's assume you have a manufacturing facility. Before the passage of OB3, all of this would have had to have been depreciated over 39 years. Now, with this new 168 provision for qualified production property, the white area in the middle, that is your actual manufacturing floor, qualifies for 100% depreciation. So if you're thinking about expanding your current capabilities or your manufacturing facilities, or you have after January 19th, you would want to carve this part out and take an immediate deduction or write-off for your costs that you've incurred. Another big benefit for corporations is the immediate expensing of R&D. If you've heard of 174 or you've done any R&D here in the US, you would have known that since 2022, the tax rules required you to amortize that R&D over 5 years if it was done domestically, or 15 years if your R&D was done outside of the US. And that was a huge impact to a lot of our clients, because what happened is they were operating at a taxable loss, but because they weren't able to expense their R&D, now they would have a book loss, but taxable income for tax purposes and have to pay tax. Fortunately, OB3 changed that and said, you know what? We're going to allow you to immediately expense that R&D back to our previous rules. But again, there are some planning opportunities, because the rules say you could either immediately expense it in the current year, or you can continue down the path of capitalizing it over 5 or 10 years. So again, what OB3 has really done is give corporations the ability or flexibility, I would say, to manage the timing of these deductions and allow them to be strategic in determining what year these expenses would be beneficial.
Sam, if I can ask a question on R&D.
Yeah, absolutely.
Any sectors, any specific sector like renewable, pharma, textile, which will benefit or take a hit from this increased deduction, oblique R&D benefit or taxes? What is your view on this?
Yeah. I mean, I don't think there's any particular sector that's going to be impacted negatively. I think the sectors that get impacted positively are actually the tech sector that does a ton of R&D, pharma, again, that does a lot of research for their pharmaceutical products. And the reason for that is, again, before they would make you amortize these costs over 5 years. So you were only getting to deduct 20% of the capital that you were putting into these expenditures. But now you can deduct it immediately in the current tax year. So again, I don't think that any industry is negatively impacted, but I do think there are certain industries that are capital R&D intensive that will benefit significantly from the immediate expensing.
No, thanks. And just a follow-up question. Do you see any tariff war having any potential impact on any of these provisions?
I'm sorry, can you
Do
repeat
you,
that question?
do you see tariff war having any potential impact on any of these provisions?
Oh, yeah. So the tariff war, I think it's impacting everybody, right? Anybody that's really doing cross-border businesses and multinationals. I mean, the impact of the tariffs is that it's really squeezing the margins of their goods and services. All of these provisions, fortunately, are provisions to help corporations manage their underlying taxable income and tax liabilities. And so while I would say on the consumer facing side, the tariffs are impacting the margins, at least on the income tax reporting side, they're able to benefit from the timing of these expenses, which will help them manage their taxable income and their estimated tax payments to help, what I would say, make their cash flow more efficient.
No, Sam, Thanks for your clarification. Really helped.
Yeah,
Yeah,
absolutely.
Sab, one more question from my side. So, are there any clawback conditions or any sort of restrictions? So, generally, what happens is you have to have minimum domestic R&D spend or a minimum domestic capitalizations around that before you get qualified for getting the foreign R&D spend. So, any sort of clawback provisions or any restrictive around these benefits?
No. So no clawback provisions or no restrictions. What really matters is where that R&D is happening. If it's happening here in the US, then you're able to really be flexible as in terms of the timing, because you can either expense it immediately today or do it over 5 years, which is an election. If you're doing your R&D outside the US, unfortunately, they still require you to capitalize at over 15 years. So it's really punitive, right, to do your R&D outside the US. And if you've been paying attention to a lot that's been going on at our capital, you'll know that there's a big push to bring jobs, manufacturing, all that back into the US. And so it's not a surprise that all the activity or the more activity you bring into the US, you're going to get a significant tax benefit for. But if you continue to leave those activities outside the US, you're going to be impacted because of the timing of when you can actually take those deductions.
Right. So it's largely about the timing. So there's no because you are preponing the deductions. So you save on the current cash. Right.
That's exactly it. It's all a timing issue at this point, because again, the sooner you can the sooner you can deduct or expense a cost, the benefit you get. That's not always going to be the scenario for every taxpayer, because what's going to happen is there are a lot of tech companies that are in losses, right? That may not benefit from the immediate expensing, that would prefer to capitalize it and expense it over 5 or 10 years. And the reason for that is if you generate a loss in the current year, you can carry it forward indefinitely, but you're limited to 80% of your taxable income in a future year.
Right.
And so
Right.
what you really want to do is manage it as to, based on your forecast, do I want to generate a loss that gets limited to 80% in the future year, right? Or do I want to continue to generate small losses, or maybe even a small amount of taxable income each year by capitalizing these costs, and therefore have a better tax cash flow perspective because you're not subject to those limitations.
Got it. I understand.
No, but great questions. Thank you so much. Another big benefit that came from OB3 is the interest expense limitation. This is really our dim capitalization rules. Before, when TCJA was first passed, they restricted our interest expense from 50% to 30%. And that 30% was on adjusted taxable income, which is the equivalent to EBIT at the time. Now with OB3, they've actually increased that limitation to EBITDA. So now you're able to take a significantly higher interest expense deduction in tax years starting after December 31, 2024. And I'll show you a quick example of what that really means to multinationals. So again, let's not focus too much on the underlying amounts, but if you'll see on the left side, under the current limitation calculation, if you had 35 million of interest expense, you would have been limited to only 30 million of deductible interest expense, and that 4.3 million would have been carried forward into a future year. On the right side, for 2025 and beyond, which is this current year, with the expansion of the definition of adjusted taxable income, you're able to take all of that 35 million, and therefore your net tax benefit is about $1 million. So again, a substantial relaxation in the amount of interest expense that organizations are able to take. And I think, one of the underlying or critical motivations for this was that the high interest rates we're currently facing here in the US has impacted a lot of US multinationals on an ongoing basis. We're going to talk a little bit about the international provisions or changes from OB3. The first one is the GILTI reform, which is the global income low taxed income. Next, we're going to talk about the FDII deduction, which is an export for serving foreign markets. And the last item will be the BEAT tax, which is our base erosion anti-abuse tax. So for those of you that aren't familiar with GILTI, which actually the terminology now is net CFC tested income, it's essentially for a US-based multinational that has a foreign subsidiary. The US preserves the right to tax that foreign subsidiary on an annual basis, and it's taxed based on our Section 250 GILTI rules. Today, because Section 250 gives you a 50% deduction from our US corporate tax rate of 21%, they would have taxed it at 10.5%. Post OB3, the 50% deduction is reduced to 40%. And so now we're going to tax, or the US will tax the income of a foreign subsidiary at 12.6% moving forward. So again, if you're US headquartered and you had a subsidiary in India, the US would have taxed that income of that foreign subsidiary at 10.5% today, but starting next year, it'll be taxed at 12.6%. You are entitled to a foreign tax credit for the taxes that you pay abroad. Today, the foreign tax credit was limited to 80% of the taxes that you paid in your foreign subsidiary. But fortunately, starting next year, you will be entitled to a 90% foreign tax credit for the taxes that you paid. The next item is the foreign derived intangible income, or what's commonly known as FDII. So if you're a US corporation and you have sales or services to a foreign customer, currently they allow you to take a 37.5% deduction on that stream of income. So your effective tax rate goes from 21% here in the US to 13.125%. Fortunately, the OB3 tax provisions have made that permanent, although it's increased the rate from 13.125 to 14%. Had OB3 not changed the underlying tax rules, the corporate or the FDII rate would have actually gone to 16.5%. So fortunately, the OB3 reduced the amount of increase that happened to this underlying provision. Next is our BEAT, or base erosion anti-abuse tax. It only applies to organizations with over 500 million in revenue. Our BEAT tax today, it's a separate alternative minimum tax where you have to do a parallel calculation on your taxable income, adding back certain related party payments, and the rate was 10%. It was subject to go to 12.5% at the end of this year, but with the passage of OB3, they've set the rate permanently at 10.5%. So this was a huge relief for a lot of what I would say global multinationals that were concerned that they would be subject to the US global minimum tax at a 12.5% rate. But fortunately, with the passage of OB3, we were able to reduce that to 10.5%. Now we're going to talk a little bit about the individual tax provision. So what was the impact of OB3 to taxpayers or tax residents here in the US? The main item is that OB3 permanently extended the reduction of the the current individual tax rates. Had the passage or had OB3 not been passed, our individual tax rates would have reset back to the historical rates before the passage of the Tax Cuts and Jobs Act in 2017. So the top rate would have gone back to 39%. Fortunately, the rates that are set today have been made permanent. The next item is that the standard deduction was permanently increased. Again, 15,750 if you're an individual or single, 31,500 if you're married filing jointly. This was raised substantially in the tax reform of 2017, and again, was only temporary. So again, a lot of these provisions or the benefits that we received from tax reform in 2017 were set to sunset or go away at the end of this year. And that's why it was so critical that Congress was able to pass these tax provisions. The next item is the state income tax deduction. Historically, or under the TCJA, we were limited to $10,000 of state income tax deduction. Now it's been increased to 40,000 for those that are itemizing your deduction. So again, if you're not taking the standard deduction, you can itemize and you can deduct up to 40,000 of state income tax that you're paying in your state of residence. This is a new deduction available for individuals. There's a deduction for car loans interest. This is the first time that this deduction was ever introduced, and it starts for those purchasing cars in the second half of this year. Again, there are income limitations, so it does not going to apply to everybody, but for the middle class and lower class that are struggling and looking to purchase a new vehicle, you will be able to deduct your interest on that car loan. Another one is a deduction for tip income. If you know that our president was adamant that tips should not be taxed and therefore subject to certain income limitations, there is a deduction for that tip income so that it's not subject to individual income tax. The next item is overtime pay. Again, our president said that people that work overtime should not be taxed on that income, and subject to income limitations. Again, there is no more tax, or there is a deduction for that overtime income so that it's no longer subject to individual income tax. And the last new item is a deduction for seniors 65 and up. If you're in this age group and you qualify for based on your income limitations, there is a deduction that helps keep more of that cash in your income in your pockets and not subject to individual income tax. The next thing is the qualified business income deduction. So for those that aren't operating through a corporation, but through an S Corp or a partnership, the TCJA allowed for a 20% deduction on that income. So if you're at the top rate of 37%, the 20% deduction brought your effective tax rate down about 3 or 4 basis points. This was set to go away at the end of this year, which caused a lot of concern for a lot of, I would say, small and private business owners. But fortunately, with the passage of OB3, we're able to make this permanent. And so now business owners that have partnerships or LLCs at the highest tax rate would only pay tax at 29.6%. The next item is this new remittance tax that we've been getting actually a lot of inquiries on. There is this new excise tax under Section 4475 of 1% on outbound payments, or really outbound wire transfer or cross-border transfers of non-qualified remittances. This new excise tax is really a way for the US, I would say, government to be able to trace unsourceable income, meaning if you are using cash or money orders to make wire transfers to individuals or organizations outside the US, the bank that's making that transfer is required to withhold 1% of that tax, of that transfer as an excise tax.
Sam, one question here. So when we're talking about this non-qualified remittances, so what exactly we really mean by that? So nowadays we use a lot of fintech. So we have seen the evolution through, let's say, we have companies like Revolut, the company like Wise, a lot of individuals, a lot of companies actually use those fintechs for making those payouts as well as for receiving the money. Is this really have a coverage on those transactions also? That's my question number one. And the second, what about it's a tax, so we understand it's an excise tax, but the understanding is that it's not gonna get any duty benefit. So if, let's say, it gets deducted from a payment from the US to India, the receiving party in India will not be able to claim a benefit under the India-US tax treaty. Is that true?
Yeah, no, you're absolutely right. So to answer your first question, the idea is that it wouldn't apply to ACH or wire type transfers, right? If you can trace the source of that income and it's coming from a bank account and you're making a wire transfer, that excise tax will not apply. Where it's intended to apply, and again, guidance is obviously lacking at this point, and we'll get more clarity as the Treasury issues guidance. It's if you're going to like a Western Union here in the US and you have cash or money order and you're asking them to send it to a foreign recipient, then that institution is required to withhold that 1% because they're trying to prevent, people transferring untaxed, right, money who are getting paid in cash, or they're trying to avoid really kind of like money laundering and funding of I would say bad organizations. And so if it's coming from a traceable source, meaning your bank account, but you're using one of these fintech apps to make a transfer to a foreign recipient, that excise tax would not apply. If you're going down to the bank and you're taking cash or money orders and the bank does not know where these sources are coming from, then they would be required to withhold that 1% excise tax.
I understand. And the second question, so on the 2G side, so I'm assuming that benefit is not available under the tax duties. Am I right?
Yeah, you're absolutely right. So there's two reasons why that benefit's not available. One is this is an excise tax that's withheld at the source. And so unfortunately, it's going to be a cost to the payor, not the recipient, right? And so the tax is paid by the U.S. person that's actually making that wire transfer. Although obviously the recipient is only getting the residual amount. The second is that excise taxes typically aren't eligible for any type of credit under any treaty. Excise taxes are kind of outside the realm of your typical tax treaty. And because this tax, in the US, we have this concept of later in time rule. So unless there's a specific conflicting provision in a double tax treaty, the tax law that comes later in time typically overrides. And in our treaties, because excise taxes aren't, especially this one, Section 4475, wasn't, foreseen when a lot of these treaties were negotiated, they don't specifically address this type of remittance tax. And so in the light of it not being covered under a tax treaty, it would not get any type of relief.
Got it. Understand.
So a couple of insights as we go through, or hopefully as you digest what the impact of OB3 would be to your organization, whether it's the second half of this year or next year, is that if you are, operating multinationally, between the US and India or any other jurisdiction, you should really review the impact to your international tax structure and model out really kind of what this means for your organization. So we spoke at a high level about the changes to the international provisions of GILTI and FDII, but if you actually get granular and start doing the calculation, you will notice that industries that are manufacturing outside the US are actually impacted more heavily in the unfavorable side than those that are manufacturing here in the US. And the reason for that is when you take a collective view of bonus depreciation, R&D expensing immediately, and then with the GILTI and FDII provisions, they've taken out a critical component of the underlying calculation. Before, they used to account for your machinery and fixed assets, and they would say that those assets should earn a 10% return, and therefore they're not subject to the GILTI or FDII benefits. But because if they've carved that piece of the underlying calculation out, if you have heavy or intensive manufacturing outside of the US, your GILTI inclusion each year, which is our CFC rules, are going to be larger because you're not going to get the shelter of the qualified business asset investment. On that same token, if you have a lot of foreign customers or you're serving foreign markets from the US, your FDII deduction is actually going to be larger because, again, they've carved out that QBI component of the underlying calculation. And so, again, modeling out the favorable and unfavorable adjustments is going to be critical before the end of the year, because you're going to want to know if you need to change or pivot or do any type of tax planning before these rules really come into effect on 1/1 of 2026. Another area of concentration or focus for a lot of our clients is understanding the accounting methods and what the impact of the timing will be on income recognition. I mentioned this or touched on this a little bit earlier, but again, each taxpayer is in a different life cycle of their underlying business. And so, modeling or understanding whether you want to stay on that 5-year capitalization for your R&D under Section 174, or do you want to make a accounting method election and go to a immediate expensing of that R&D, is going to depend on where you are in your taxable income life. Because again, NOLs that you generate in the current year, while they don't expire, will be subject to the 80% limitation in the future years, and therefore may not be as beneficial as capitalizing or spreading out these costs over 5 or 10 years. The other item is the new, qualified production property deduction, which allows you to expense the improvements that you're making to your factories or facilities in the current year rather than 39 years. 39 years to amortize that cost is very long time, right? And so again, you have to make these accounting method elections on your current return so that the IRS recognizes the method that you're going to be doing in your future years. The final item is reviewing your transfer pricing policies. Again, with the changes to the US tax landscape and what that means to your underlying organization, it's a good time to review what your transfer pricing policies should be starting next year. Again, the US corporate tax rate is permanent at 21%, but there are different levers where your foreign CFC will be taxed at a higher rate no matter what next year under the GILTI rules. But again, the FDII deduction has been increased, or the tax base has been increased. So maybe you want to change the way that you're currently viewing your transfer pricing policies. So again, having a fresh look at your underlying organization and what your global landscape looks like in the future years is going to be critical to making sure you're optimized moving forward.
Got it, Sam. So, Sam, couple of questions I have. So, on this, there was a discussion around imposing the higher taxes on foreign companies or foreign individuals who are coming from countries with unfair foreign taxes. If I recall, it was being referred as Section 899 in the OB3 tier. What is the impact, and how do you see this is going to harm the Indian corporates out there?
Yeah, no, that's a great question. So Section 899 was definitely a important topic when it was first introduced about 2-3 months ago. And the theory behind Section 899 was that if a foreign country imposed a discriminatory tax on a US multinational, the US would have the right to tax companies headquartered in that jurisdiction at 5% starting next year, increased over a 4-year period up to 20%. And the real driver for that was that the US has not adopted Pillar 2. So as you know, as multinationals, OECD and BEPS has been a topic that's been on really everybody's mind and every tax conference that you probably attended over the last 3 or 4 years.
Right.
And the US has been adamant that we're not going to adopt a global minimum tax. Our backdrop to that was we had CFC rules under the GILTI regime, which would tax the income of our foreign subs. We also had BEAT tax, which is our base erosion tax, which is our kind of parallel global minimum tax that we implemented. But we weren't going to mandate that our US multinationals had to pay a minimum 15% in each jurisdiction that they operated. And if you're familiar with how Pillar 2 works, there are different levers in how these OECD countries were going to implement this minimum tax. Either they could impose a global minimum tax at the local country level. And if that local country didn't have a minimum tax, it would have gone to the parent jurisdiction. And again, if that parent jurisdiction didn't have a minimum tax, which is the US in this scenario, another country in that organizational structure would have had the ability to tax the US, right? And so Section 899 said if you had those regimes, we were going to implement or enforce a separate reciprocatory tax on that country or companies organized in that country.
Okay. So, but the good news is that it's not there in OB3. Am I right?
Yes, you are correct. So Section 899 was removed because the G7 agreed to not enforce a number. Again, there's no clarity, but they said they weren't going to enforce the Pillar 2, right, taxes on US-based multinationals. We don't know how that's going to happen yet, right? There's no clarity. They've just said that we will not enforce it if you do not include 899 in your tax package. But the US has reserved the right to, again, proactively enforce or implement Section 899 if the other countries do not implement their proactive measures.
Okay, so what I hear is that there's still a probability in the near future that US might still bring this 899 or the equivalent tax provisions in its tax laws. There's still a probability.
Absolutely.
I understand. Okay. One more question after looking at all these benefits, these provisions in the OB3 tier. See, if you look at, there are a lot many Indian companies, founders who have formed their US holdcos largely to either for a US listing or to have an access to the US funds, right? But their business activities, they are most of it are outside the US, if you put it that way. How do you see those getting those corporates, those structures getting impacted with these changes?
Sure. Sure. So overall, at a high level, OB3 is definitely pro-business, meaning it was implemented with the idea of supporting the growth of US multinationals, right? Or US organizations. If you're not manufacturing and you don't have a lot of substance, as you referenced in the US, where you have less substance in the US, the provisions aren't going to be as beneficial as those that have more activities in the US. And it's an overarching, I would say, concept or principle of our current administration. And so to the extent that you have a, India-based corporation or individual that's, has US activities, but they're not doing R&D or they're not expanding or manufacturing, you're not going to have as much of a benefit from the provisions of OB3 as you would the other way around, meaning US-based multinationals that have operations outside in India.
Got it.
And Sam, just a follow-up question on this, just for the understanding of our Indian audience. Does OBB has any impact on dividend or capital gain on the investment which the Indian resident may have invested in US? Does it has pre-OBB and post-OBB any impact? Just for a simple understanding.
Yeah. At a high level, no. The reason for that is it didn't impact, OB3 didn't impact any of the withholding rates or override any of the treaties that we currently have in effect. I think Section 899 was a threat to that because it would have implemented a withholding tax and it would have, in theory, overridden a number of our double tax treaties. And so that's where it would have impacted India-based multinationals if India was viewed as a discriminatory country. We don't know which countries were on that list, to be quite honest, because it was never disclosed, but we could foresee that a lot of countries that, unfortunately, a lot of our trading partners, right, would have made that list, which would have impacted margins significantly.
Thanks.
Yep. I think we are done with this presentation from Sam. So Shreya, it's over to you. If there are any questions from our audience, from people who have joined in there, unless until it's not answered by Sam in his presentation. So I think the floor is open for them.
Thanks, Nitin. Thank you so much, Sam. That was a very informative presentation. Just to wrap up, we have a couple of questions from our participants. Let's start with the question from Mr. Nishant Shankar. He wants to know, in your view, what's the most significant practical change this bill will bring for businesses or individuals, and what's the one challenge you think stakeholders are underestimating?
Sure. No, that's a great question. I think the biggest impact is the bonus depreciation and immediate expensing of R&D. Again, you can't emphasize the benefit of being able to deduct costs in the current year. And so it's going to help a lot of multinationals. I think the one area where a lot of people aren't giving enough credence to or focus on is understanding what the impact to the underlying calculations are for the international provisions, primarily the FDII deduction and the GILTI tax. And the reason for that is while the rates were, made permanent, and so they weren't set to sunset, the underlying variables in that calculation have been impacted. And I don't think taxpayers understand that you really need to model what that really means, because next year is going to be, it's going to look significantly different than the current year.
Sure, thanks, Sam. Another question that we have from one of our participants is, what is the likely impact of the tax provisions related to outward remittances from the US, especially for India? Does this provision only impact person-to-person remittances, or will this provision also impact cross-border business remittances?
Yeah. So the remittance tax is only supposed to apply to individuals, not businesses. So cross-border business-to-business activity will not be impacted. Where it's really going to have its impact is those that are trying to make cash or wire transfers. Again, what the US is looking to prevent is people sending money back home to their families or whatever it may be. And so it only impacts individuals at this time.
Thanks, that clarifies this. Also, one more question is, are standard deductions increased for single QSS head of households?
They haven't been increased, but they've been made permanent, meaning the deductions were actually set to go back to the old standard deductions prior to the passage of the TCJA, but now they've been made permanent. So the standard deduction is has a provision to account for inflation, but it's still a significantly higher deduction than what we had before. And so I think this year it's like 15,750 and 31,500 for married filing jointly. Before, if you knew, it used to be like 5,000 and 10,000. So again, it's tripled since the passage of the TCJA. And fortunately, it did not sunset and go back to the old deductions, and it's staying at its high amount.
Sure. Another question, Sam, is, could you please address the question of, I know that Kunal spoke about it, but could you please address the question of payment received by Indian individuals from sale of shares in US entities, and especially receipt of dividend from US entities, on applicability of remittance tax under the above act?
Yeah, great question. So on the sale of shares, the US typically does not tax capital gains for non-resident aliens, which are foreign individuals that sell shares of the US. That even applies to if you are an individual and you are investing in the US stock market. The only time that answer changes is if you sell shares in a company that's viewed as a US real property holding company, meaning we have the FERPTA regulations that say we won't tax capital gains unless it's based on US real estate. If that's not the case, the US does not tax the capital gains. I will also caution that I mentioned that if you were to invest in the US stock market, that we do not tax those capital gains. That is an accurate statement, but you do need to be concerned about having assets in the US and our US estate tax concerns of making those type of investments, which are really outside the scope of this. But again, I wouldn't say go ahead and, I would caution everybody going and rushing to the US stock market thinking that they're not going to pay US tax. In terms of the dividend remittances, unfortunately, one of the limitations is that there is a withholding tax in the US on dividend remittances. We do have a double tax treaty with India, but it's not as favorable as obviously all of us on this panel would like. So there is a withholding tax on dividends, and the withholding tax rate does depend on whether it's being paid to an individual or a corporation.
That's a very comprehensive answer, Sam. Thank you so much.
Yeah, but sure. So the underlying point is that it doesn't changes anything pre the OBB 3 versus the post OBB 3. So that's what Sam has tried to highlight.
Sure.
Yeah, that is correct.
So, keeping in mind the time, let me swiftly move on to the next question. Are there any specific components in OB3 which will have impact on M&A space, like whether 100% expensing will be available in case of asset acquisition under 338? And adding to this, will there be any specific impact on states on account of OB3?
Sure. Was it M&E or M&A? Sorry. I
M&A,
think the question was asked
M&A, mergers and acquisitions.
M&E.
No.
Mergers and acquisitions. Okay. Yeah. So in terms of OB3, there will be an impact. This is a great question. I didn't think about it. There will be an impact on mergers and acquisitions and 338 elections because, as you know, when you make a 338 election, you're making a stock purchase for legal purposes, but it's an asset acquisition for tax purposes. Fortunately, because of bonus depreciation, if you do a 338, because it's an asset deal, you will get immediate bonus depreciation on the asset purchases that you're buying in that deal. So yes, OB3 will significantly benefit 338 elections in M&A transactions. Absolutely.
So Sam, so what you're saying is that there will be a step up immediately available in an asset purchase transactions, and you can immediately depreciate it 100%. Is that what it is?
Exactly. So
That's a huge
you would.
benefit.
It is a huge benefit, and that's a great question because I didn't even think about that, to be quite honest. But
Right.
yeah, you're buying your assets at fair market value and getting an immediate benefit of the bonus depreciation. So you will probably see a lot more asset transactions in the near future than stock transactions.
Sure. Nitin, do you have anything to add to this?
No, nothing. That's it. I'm still processing. This is big.
Okay, so
I think there was one more question, right? On that, there was a second question.
yes, will there be any specific impact on states on account of OB3?
Yeah, sure. Yes and no. So states have their own rules. A lot of, or the vast majority of the states adopt the federal tax code. And so to the extent you get bonus depreciation at the federal tax level, you will benefit from it at the state level. There are certain states that don't conform to the federal tax provisions. And so the states will require you to add back bonus depreciation. And again, some states tax GILTI income, some states don't. So overall, at a high level, the best way to think about it is that your state taxation always starts at your federal taxable income amount. And because your federal taxable income will already account for bonus depreciation, immediate expensing of R&D, your qualified production property deduction, you will or you should see a benefit on your state income tax liabilities.
Sure, thanks, Sam. We don't have a last question. We have a last comment for Sam, which is that it was a lovely presentation, and I definitely echo that sentiment. So I think we are
Thank you so
almost
much.
we are almost out of time. And Nitin, would you like to add anything before we close
No, I
this?
think it was lovely presentation, Sam, and thank you so much. I hope our audience would have got their queries or their questions answered to most extent. But of course, if they are not, we are available. Kunal, me, Sam, all of us are available to sort of talk to off the line on any of the issues they might have in India or in the US.
Sure. Thank you so much, everyone. A special thank you to our fantastic speakers, Sam, Nitin, and Kunal, and to all of you for joining us today. The one big beautiful bill may be complex, but after today, we feel it is a lot more manageable and maybe even a little less intimidating. Let's keep the momentum going, keep asking the right questions, and be ready to act before the changes hit. On behalf of USISPF and SW India, thank you, stay informed, and we'll see you at the next session. Have a great evening, have a great weekend, everyone. Thank you so much.
Thanks, everyone.
Thanks,
Thank
everyone.
you, Shah. Thank you for this platform. Thank you.